Imagine you're at a yard sale and there's a vintage vase on the table. At first, it's priced at $10. It's not the most special thing in the world, but it has some charm. Then someone picks it up, admires it, and tells the seller, "Hey, I know someone who might pay $50 for this." Now the seller thinks, "Wow, if I could sell it for $50, why not ask for $30? And so the price goes up to $30. The next person who comes by sees that $30 price tag and thinks, this must be a really rare vase. I bet someone will pay $50 for it, just like they said. So they buy it for $30 with the hope they can flip it for a bigger profit. And slowly, more people start buying and reselling that vase, each time pushing the price higher. Before long, it's worth $100. People are buying it, not because they actually think it's worth $100, but because they believe they can sell it for even more later. Now here's the kicker. When someone finally comes by who doesn't think they can sell it for more, the price starts to plummet. No one wants to be the last one holding the vase at an inflated price. Suddenly the vase isn't worth $100 anymore. It's worth a fraction of that, maybe $10 or $20, and everyone is scrambling to get out before it hits rock bottom. This, my friend, is how a stock bubble works. A stock bubble is when the price of a company's stock rises far beyond its actual value. This can happen when investors get overly excited, driven by speculation, hype, or just plain fear of missing out. The price keeps climbing because everyone is buying in, hoping they can sell to someone else for a higher price later. But here's the problem. Once reality sets in and the hype dies down, the bubble bursts and the price crashes. Let's talk about why AI stocks might be the next bubble to burst. You've probably heard a lot about AI lately, right? It's all over the news. AI is revolutionizing everything from self-driving cars to healthcare to creating music. And for a lot of investors, AI has become the vintage vase of the stock market. Companies like OpenAI, Google's DeepMind, and NVIDIA have been grabbing headlines for their breakthroughs in AI. As a result, everyone has started pouring money into AI stocks. If AI is going to change the world, then investing in these companies must be a no-brainer, right? But here's the thing. Just because a stock is trending doesn't mean it's worth the price it's selling for. Let's break this down with a quick example. Imagine a tech company that's been getting a lot of media attention for its new AI-powered software. The stock price starts to rise as more investors get excited. The problem is, the company hasn't actually proven it can turn a profit yet. Maybe it's just in the early stages of development, or it's still working on improving its AI. Yet the stock keeps climbing because investors are betting that AI is the next big thing. This is where the bubble starts to form. The price continues to increase, not because the company is actually worth more, but because people believe the hype. The fear of missing out kicks in, and suddenly, everyone's trying to get a piece of the action before the price goes up even more. But here's the dirty secret. Many of these companies haven't fully mastered AI yet, and they might not even be the ones that eventually dominate the market. Let's use the AI stock of a fictional company called AI Widgets as an example. Right now, everyone's buying up AI Widget stock, convinced that it's going to change the world. But in reality, their AI software still needs a lot of work, and there's no guarantee they'll beat other more established players in the industry. Still, the stock price keeps climbing, and investors keep pouring money into it. This is a perfect setup for a stock bubble. As with the yard sale vase, it's not about the company's real value. It's all about speculation. People are buying based on the belief that they can sell their shares for more money in the future, rather than the company actually being worth more. So what happens when the hype dies down? When AI Widgets isn't the next Google, and people realize the company isn't going to dominate the market, that's when the bubble bursts. Investors panic, sell their shares, and the stock price crashes. Suddenly, that $100 stock is back to $20, and anyone who bought in at the peak is stuck holding the bag. This is why AI stocks, like any other bubble, can burst when reality catches up with speculation. The companies may still have great potential, but that doesn't mean their stocks are worth the sky-high prices they're trading at right now. Now let's go a bit deeper into what causes a bubble. There are a few key factors at play. Speculation and hype. Investors get caught up in the excitement of a new trend, like AI, and start buying based on what they think the future holds, not what the company is actually doing today. FOMO, fear of missing out. When prices are rising quickly, people don't want to miss the chance to make money, so they jump in. This pushes prices even higher, even though the company may not be worth that much. Overvaluation. This is when a company's stock price is much higher than its actual value. It's like paying $100 for that vase, even though it's only worth $20. In the case of AI stocks, many are trading at valuations that don't match the company's real earnings, profits, or future potential. The inevitable crash. At some point, reality sets in. Investors start to realize that the stock isn't going to live up to the hype, and they sell their shares. This causes the price to drop rapidly, and the bubble bursts. You can already see some signs of this happening with AI stocks. While companies like Nvidia are doing great, many smaller AI-focused startups are seeing their stock prices climb far faster than their actual business growth would suggest. So, how can you protect yourself if you're interested in investing in AI stocks or any other high-flying stocks? Here are a few things to keep in mind. Do your research. Just because a stock is getting a lot of media attention doesn't mean it's a good investment. Look at the company's fundamentals. Are they actually making money? Do they have a proven product or service? Don't buy on hype alone. The next big thing is always tempting, but investing based on hype is a dangerous game. Make sure you understand the underlying business before buying in. Diversify your portfolio. Don't put all your eggs in one basket, especially if that basket is full of speculative stocks. Spread your investments across different industries and asset classes to reduce risk. In the end, a stock bubble might seem like a quick way to make money, but it's a risky gamble. AI stocks might be the hottest thing today, but tomorrow? Who knows? Just remember that when the bubble bursts, you don't want to be left holding a stock that's worth less than what you paid for it. And as with any investment, patience and caution are your best friends. The best opportunities often come from steady, long-term growth, not from trying to ride the wave of the latest hot trend. That's what a stock bubble is all about, and why AI stocks might be the next to burst.